Hey there! Have you ever stopped to think about what a bank actually does with your money? Most people imagine banks as giant money warehouses. You deposit your cash, the bank keeps it safe, and over time, you earn some interest. But then a big question comes up. If banks are just storing money, how do they make so much profit? Well, here's the surprising truth. Banks don't just store money. They actually create new money when they give out loans. No printing machines, no stacks of cash, just numbers typed into a bank account. It sounds crazy, but this system is the foundation of modern economies. In this video, we'll break down the biggest misconception about banks, whether banks can create unlimited money, how banks make and lose money, why this system exists, and what happens when it goes wrong. Let's get started. The misconception: how people think banks work. Most people think banking works in a very simple way. You deposit your money. The bank puts it in a big storage box. Then when someone wants a loan, the bank takes some of your deposit and lends it out. Sounds logical, right? This idea is often linked to something called fractional reserve banking. But this story is actually wrong. Let's clear this up. The word fractional means only part, and reserve refers to special money that banks use to pay each other, not money from your deposits. For example, when you transfer money from Bank A to Bank A must send reserves to Bank B. These reserves are digital money, are created by the central bank, can only be used by banks, never leave the banking system. You cannot withdraw them. You cannot use them to buy things. Their only job is to settle payments between banks. And here's the key point. Reserves do not come from your deposits. If banks need reserves, they borrow them from the central bank or other banks, not from your savings. Simple example. Wee Bank. Let's make this simple. Imagine a bank called Wee Bank. 10 people deposit $1,000 each. Total deposits equals $10,000. Now let's say Wee Bank has $1,000 in reserves, which came from the central bank. A person named Bob wants to borrow $1,000. If the reserve requirement is 10%, the bank needs $1,000 in reserves for $10,000 in deposits. Since the bank already has $1,000 in reserves, it can approve the loan. So what happens? The bank doesn't give Bob someone else's money. It simply creates $1,000 digitally and credits Bob's account. Now, total deposits equals $11,000. Reserves equals still $1,000. If another person, Lisa, wants a loan, the bank can't lend anymore because 10% of $11,000 equals $1,100. But reserves are only $1,000. Modern reality. In the past, banks had strict reserve requirements like 10%. But today, in many countries, including the United States, the reserve requirement is 0%. That's why people say, banks create money out of thin air. But does that mean they can create unlimited money? How banks make and lose money. So how do banks actually make money? 1. Interest Bob repays. $1,000 loan plus $200 interest. The bank earns $200 profit. Why not $1,200? Because the bank already lost the $1,000 earlier when Bob spent it. What comes back is just the original amount plus interest. 2. Investments. Banks also invest in government bonds, safe financial assets. Their money isn't just sitting idle. 3. Losses. If Bob can't repay the loan, the bank absorbs the loss, using its own cash, reserves, or capital. So banks don't get free money. They take real risks. Why this system exists. So why do we use this system at all? Because modern economies need credit. Businesses borrow to expand. People need mortgages. Governments borrow to function. If we relied only on savings, growth would be slow and limited. But this system has risks. If banks lend too much money enters the economy, prices rise, asset bubbles form. As money leaves the bank through spending, cash and reserves fall. If many customers demand money at once and the bank can't pay, bank run. Governments may respond with withdrawal limits or bank holidays. But these actions often increase panic, just like during the Great Depression. The real limits on money creation, 1038. Today, the real limits are capital and liquidity. Capital, the bank's own money used to absorb losses. If too many loans fail, capital disappears and the bank collapses. Liquidity, how easily the bank can pay withdrawals and transfers. If liquidity runs out, lending slows, panic starts. Bank runs happen. That's why banks are very strict about loan approvals. So here's the truth. Banks don't simply lend out your savings. They create new money when they issue loans, but they still depend on cash reserves, capital. This constant expansion and contraction of money shapes the modern economy. And that's why when banks fail, entire economies can collapse. So next time someone says, banks create unlimited money from nothing, you'll know it's not that simple. If you enjoyed this video, consider liking, subscribing, and becoming a member to support the channel. Thanks for watching.